So you want to get into futures trading, or maybe you already have, and you don't know what futures trading actually is. If you're at a dinner party or you're walking out and about on the streets, or even a friend and asks you, what do you do for a living? And you say, day trade. And they say, oh, what do you do? Options? And you say, no, I do futures. You need to be able to explain what futures is. The amount of people I see on social media that don't even know what actually future trading is ridiculous, right? So we need to, please lock in for 10 minutes. That's all I ask you, lock in. You will save yourself so much embarrassment. And not only if you have an actual answer that sounds professional, you'll be taken more serious. People will think you're more legit and you'll be more professional, right? Because day trading nowadays, it's just like, oh, you day trade, and social media gives it a bad rap. And so we're trying to be as professional as possible here. So please lock in, take some notes, write this down. This video is important. So what is futures trading? It's an agreement / contract, what is contract? A legal agreement, to buy or sell something at a set price on a set future date. So they're agreeing to buy or sell something for something in 6 months from now, 3 months from now, 2 months from now. Whatever the contract expires, and they will purchase that, right? In 3 months from now. So the best analogy is, you guys see the little cowboy here. This is the farmer, bro. This is the farmer. And this is like the most basic analogy you could probably find on Google, but it's between a farmer and a corporation, right? Look at the money guy, it's greedy. And the farmer he's a tomato farmer, and he's selling tomatoes $20 a pound. And he is going into the season, and he's about to plant all these tomatoes and have this huge harvest and wants to make money at the end of it. But he's worried. He's worried that by the end of the season, in 3 months from now, his tomatoes are going to lower in price. There's going to be so many tomato farmers that essentially his tomatoes are going to be worth nothing, or at least go down in value a lot, significantly. So his $20 a pound, he goes to the corporation and says, hey, corporation, can I agree, can we make an agreement, can we write out a contract that you will buy a portion of my harvest for $20 a pound in 3 months from now, no matter what? So even if the price drops to $2, they already made an agreement. So the corporation is essentially screwed. But the corporation agrees. And why does the corporation agree? Because the opposite could happen. The price of that item could triple, could double, you know what I mean? So that it could be $100 a pound. Obviously not, but it could go up in price. So the corporation, oh yeah, there might be inflation, there might be a scarcity in tomatoes, so I'm going to agree on this and buy it for that price. So both of them win. And what the farmer's essentially doing is hedging his bet. I'm going to sell this person for this specific price, and if it does lower, percentage of my harvest, if it does lower, at least I made something, at least I cover my costs. So what future trading was, and it still is hedging your bet. And now how does this go to TradingView, NQ, stocks, all this stuff that you see now on social media? Why does everyone want to be a futures trader? Well, everyone wants to be a futures trader because of leverage. The increased buying and selling power that you guys have. But you guys got to understand, what are we all doing here on the charts, right? This is TradingView, this is Nasdaq. We're trying to buy Nasdaq. This is the most retail trader friendly index that you can buy, and everyone utilizes it. But the index itself, you can't actually buy or sell it. The index itself, right now, you can't actually buy or sell it. If I click here, it'll log in, but I can't actually buy this. I'm just looking at this. This is essentially a scoreboard. Let me delete the farmer and whatnot. This is just a scoreboard. Imagine it's just projecting 100 stocks. Remember, if you watch my other videos, Nasdaq or NQ is the top 100 tech companies in the US. This is just a projection of it. That's all it is. It's just showing me it. You can't actually buy it. So I can, it's one order book. That's the best way I can describe it. One order book. Right? It's literally just one order book. Write this down before I delete it. Or go back. This is just one order book. And let me double my screen and show you futures. This is E-mini futures, right? This is very important. So this is essentially one order book. Just projecting the price of 100 tech companies. So that's Nvidia, that's Meta, that's Microsoft, all these companies that you see everywhere, right? It's just all the stocks, 100 stocks, and just a projection. You can't actually trade the actual index. Futures, you can actually trade. Oh my God, my bad. This is not one order book, 100 order books. Whew. This is 100 order books because it's 100 companies into one. 100 stocks into one. What futures is one order book. Oh, mess up. No. Rewind that. One order book. So this is 100 stocks into one. This is one singular order book where everyone's trading on. And the price depends on the people trading it. And the reason why, let me go on the 5 minute. So this is literally just a projection, and this is just what people are trading on. And if you look pretty closely, oh my God, why do they look the same? If these are just buyers and sellers and nothing else, and the stock doesn't really affect it, why do they look exactly the same? Well, good question. Good question. I hope you did ask that. I hope you had some critical thinking there. But essentially, why it looks exactly the same is because institutions are using arbitrage, or using mathematical models that every time the index and futures move apart, they are trading it in milliseconds back together. And let me just give a perfect example. Let's just say the index does this, and futures do this, right? It's still going to go up with each other, but this gap right here, right? This gap. Let me make this another color. That gap is essentially what they're trading. So they will trade the index down. And again, you can't actually trade the index. I can already hear you through my screen. Oh, but you told me you can't trade. Yeah, I know, bro. I know you can't trade the index. They have models that they're literally trading all 100 companies at the same time, or ETFs. Okay, I'm not going to get too much into that, but they're either trading all 100 companies that you see slightly down, they're selling, or they're trading just one ETF. It doesn't really matter. But they are trading futures back up to that price. And most of the time that happens, right? So we can see that time and time again. That every single time, and most of the time on the chart, they will look exactly the same, and for that reason, because of institutions. If it was just retail traders, they wouldn't look the same. But there's so many mathematical models, the second they go slightly apart, they're getting trade back together. And like I said, that's the inefficiency of the market. Okay? So stay with me now, right? That pretty good example, right? Right? So the reason why futures leads often, right? We can see that futures is always either a bit higher or a bit lower. You know what I'm saying? Futures is always leading the pair, is because it's open 23 hours of the day. Type that down. And then this, it's open from, the actual index itself is not open for 23 hours a day. It's open 9:30 a.m. to 4. Okay? So what does this essentially mean? If this is open 23 hours a day, and this is only open from 9:30 to 4, right? What this allows futures to do is to get ahead of the market. It allows it to price in news events overnight. It allows it to use the models itself. The institutions are actually trading on this at night. They can react to different macro events sooner, quicker. There's so many different reasons. And because it's one order book, it will move way more. It will be way more volatile than the actual index because it's one order book. Not way more, obviously, but it will be the leading pair. If it's open 23 hours a day and it's one order book, it will be the leading pair no matter what. So, right, essentially and then let's go back. So you guys know what the index is, and you know why people trade futures. Let me go here. Let's go to futures. So we see the index, we don't care. We want to actually trade on something that we can trade on, and that's the actual pair itself. So now we're on E-minis, right? And again, like I said, with futures, you can actually use leverage, which is an increased power in buying. And by doing that, you need margin. And what margin is essentially a security deposit for you to utilize leverage and get that increase in power of buying or selling. And what it is every 3 months, so every quarter, you guys need to know what quarterly means and what quarters are. Every 3 months, a futures contract expires. When it expires, it has a new contract. So there's a lot of rules. You can't hold through these contracts, right? So you can't hold. And a lot of times what futures is for scalping. You don't want to be holding these contracts. And it won't let you. All these brokers, and a lot of them have different rules, will liquidate you, which means that they will completely close your position, turn it into cash, and give you back the cash. They're not going to take your money. But you cannot hold through contracts. Because like I said again, by holding through a contract, you're agreeing on the actual agreement. And that's where, I'm going to go into gold. So where's futures gold at? Gold futures. So this is every 2 months. The contract expires every 2 months. 99.9% of brokers are not going to come to your house with gold bars. But when you guys see those memes online like, oh, my futures contract expired, I forgot to close it, and they come with like cattle, and there's like cows. Essentially, if you were to hold gold the entire contract, and you need to have enough margin, you need to have enough to actually hold it. You can't just put $1 in. You need enough to actually buy the specific item or whatever it is, or have the agreement set in stone. But they're just going to close your position. Brokers are not going to come to your house with ounces of gold. But theoretically, going back to history, we talked about the farmers. If you were to hold the futures gold contract at the end of 2 months, you're agreeing on that agreement, and their form of that is paying you out in gold. You're buying gold, right? So, but they're not. It's not like 99.9. I'm not going to say 100 because again, there's commodity traders are real, and this happens all the time. But on these brokers, don't be worried about that, and you won't even have enough initial margin to not get closed and liquidated. So you don't need to worry about that. But gold and Nasdaq and the S&P minis and micros is what you're going to see all the time. And let's go into micros. This is pretty standard, right? Micro and Q. There we go. This is E-minis and this is micros. And what micros essentially is, it allows you 1/10 the position size as minis. So this is very beginner friendly. It's more volatile, and I never trade micros, but it's pretty much the exact same. The best way to describe it, it's the same market but 2 different ways to trade it. If that makes sense. So this is very beginner friendly. You don't need as much to start with. It's 1/10 of minis. So there's micro S&P, micro Nasdaq, and gold, the S&P, and NQ are what you're going to be trading on. So if you see MNQ, it's micros. So 10 micros is 1 mini, right? And this fluctuates a lot depending on the regime we're in, depending on how much news we have, right? So the market goes up and down, but I'm not going to get in there. That's essentially the basics for futures trading. I don't think you guys need to know much more than that. More is going to come in future videos, but I hope that was a pretty good explanation, and you guys can finally go to your cookout or whatever it is, I don't know, Thanksgiving dinner, and maybe give out the farmer example. I don't know, talk about what futures is and how you can utilize leverage. And that was just very beginner vibes, but in the future, we will be discussing how you can utilize leverage and what margin actually means in your different way to position yourself within the market. So this is a super beginner friendly thing. Make sure to like, subscribe, comment. This bootcamp video is about to get serious. You guys need to lock in though. So that's it for me.